a brief introduction of myself. I'm an economist and a strategist and investor by trade, and I have been investing in financial services and healthcare technologies through venture capital fund, and also through the corporate venturing and through a corporate M&A for a good part of last 2 decades. Most of my acquisitions or investments have been in Europe and Asia, and in small part in US. I also additionally mentor entrepreneurs for the Mayor of London's International Business Partnering Program and Business Growth Program. Also for Pitchett Palace, which is sponsored by the Royal Family of UK. And in addition, I'm a contributing author to the AI book, and I blog on technology, innovation, AI, and ethics. In terms of the startup specifically, what we are seeing, and also this is our advice to the startups, is just look at your burn rate and your runway. What I mean by that is look at your financial statement, your cash flows, see where are you spending the money, what are the sources of expending money, which of these could be delayed or could be stopped for a short period of time so that you can conserve cash. Then again, in terms of sources of inflows, look at the runway that you have left of the investments that have been put into your company. Will it be sufficient to go through this entire crisis? So that's on the cash side. Then we look, urge the startup entrepreneurs to look at their business model. So look at your current business model and see if there are any changes you can make into the business model, into a flexible business model, to actually fight the current COVID crisis. Are there specific opportunities or specific way you could be working, say through digital channels or through other supplier relationships which may be less impacted, or through any corporate relationships or government relationships which could be in short-term leverage. So that's a short-term model. And then you have to estimate how long is this going to last, this crisis, and what does it mean for business model? Is it a 3-month play, a 1-month play, or is it a 3-year problem? You need to therefore anticipate and rejig your business model. As a startup, you have a luxury to have not very institutionalized ways of working and huge regulatory burdens, huge infrastructure burdens. So you can tweak your model very much easier than a large player could. And then anticipate what your investors will do. What we're seeing from the investment community is a lot of what we call dash for cash. They are also conserving cash and seeing how it pans out. There are some actions which some investors do in what we in my investment community call BTD, buy the dip. But that has also taken a bit there are many investors who are more dovish than hawkish on that. They are saying, okay, let's wait and watch. We've never experienced this kind of crisis before. Buy the dip might not be the right kind of strategy. So we're seeing that from investors. Finally, where we are seeing a lot of good support is coming from the government. So a lot of governments, including the UK government, Rishi Sunak, to announce a 1 billion fund which will co-invest with other investors into startups to shore them up for this current crisis. There are also some loans which are available to small and medium enterprises, which can be accessed to buffer the cash flow of these enterprises. So it is a hard time, but it is hard time for all, and flexibility and being able to think through various options and implement might be is something that I would advise specifically startups. In terms of what we're seeing is, so if we look at the digital health space in itself, in the Q1 2020, we saw nearly $3 billion going into 82 funded deals in digital health. And this is a staggering jump of 49 deals. So that's 50 deals extra have happened in Q1 2020 versus what we saw last year. And I think last year, the total investment in healthcare space was down from 17 billion in 2018 to 16 billion this year. So where is this money going? And what we're seeing is that investors are investing in a whole chunk of money in telemedicine, remote monitoring, symptom checkers, and triage tools. So this is very, very obvious. We are seeing that there is a move to digitization because you cannot visit your healthcare professional. There is a need to be self-isolated, so you need to do this on your own. So therefore, telemedicine and remote patient monitoring and symptom checkers are becoming a good investment opportunity for investors. In terms of the specific deals, we saw Crew, which is the Swedish Levy, it's also called, provider of telemedicine, attract 152 million funding. K-Health, which is a US telemedicine company, got 48 million. In fitness, we saw a massive chunk, 285 million, which went to ClassPass. So that's on the VC side. What we are seeing in global stock markets, which is where the majority of the money, investor money is going, we're seeing that S&P, broad market S&P has slumped in the last 3 months 18%, and Dow Jones has slumped 20%. But the top performing healthcare funds are down only 5.1%, and the worst performing in Morningstar's health category is down only 9.3%. Some of the interesting players which have actually gained through the crisis actually maps very well with what we are seeing in the VC space. So Teladoc, which is a US virtual health services provider, its stock price went up 75.9% in these days. So 75.9% up. And then what we saw is Lonza, which is, again, this also maps with the current crisis. Lonza is a leading supplier of active pharmaceutical ingredients and biopharmaceutical for the research industry. Their stock went up 10.6%. Dexcom, which does blood glucose monitoring, its stock for diabetics, its stock went up 13.4%. So just in the broad market and also in the VC space, we are seeing a lot of interest in telemedicine, symptom checker, remote patient monitoring, all predicated from the social distancing and isolation and non-pharmaceutical interventions that governments have imposed.